While you stare at the flickering red candles of your favorite altcoin, a silent vacuum is operating behind the curtain of the global markets. This is the institutional siphon. Retail sentiment currently sits in a frozen state of neutral indecision, paralyzed by the memory of previous crashes. Yet beneath this surface of stagnation, systematic investment plans from the world's largest asset managers are reaching record highs. New exchange-traded funds for Bitcoin and XRP are no longer just financial products. They are high-capacity industrial pumps. They are drawing liquidity away from the frantic retail hands and locking it into the vaults of sovereign wealth funds. The divergence has never.
The mainstream media wants you to believe that the crypto market is a chaotic casino driven by hype. The mainstream media wants you to believe that the crypto market is a chaotic casino driven by hype and memes. This is the false reality designed to keep you sidelined while the smart money builds its base. Retail investors are currently distracted by short-term price swings and the fear of a sudden correction. They see neutral sentiment as a sign of weakness, failing to realize that this quiet phase is when the most aggressive institutional accumulation occurs. While you wait for a signal to buy, the big players are already setting the floor. They thrive on your uncertainty because it allows them to acquire massive positions without moving the needle too early. Don't fall for the noise.
Look closely at the data, and you will see a pattern that retail traders consistently ignore. The inflow of capital into Bitcoin ETFs isn't just a trend. It's a structural shift in how liquidity enters the space. We are seeing a transition from speculative gambling to a systematic, SIP-based investing model used by institutional desks. This creates a relentless buying pressure that operates regardless of daily price action. Even as retail volume dips, the institutional siphon continues to drain the available supply from exchanges. This divergence is the smoking gun. It proves that the smart money is preparing for a supply shock that the average investor hasn't even begun to calculate in their trading strategy yet. We are now approaching the most critical battleground in the current market cycle, the $68,000 to $70,000 support zone for Bitcoin. To the untrained eye, this looks like a simple resistance level being retested. However, our technical breakdown reveals that this range has become the designated entry point for massive institutional buy orders. This isn't just a line on a chart, it is a liquidity floor reinforced by billions in ETF backing. If Bitcoin holds this zone, the structural integrity of the bull run remains unchallenged. The institutional siphon is effectively building a fortress at 68K, ensuring that any retail sell-off is met with an immediate, automated wall of institutional buying power that prevents further downside. While Bitcoin captures the headlines, a secondary siphon is being constructed through the newly proposed XRP ETFs. These vehicles represent the bridge between traditional cross-border settlement systems and the new digital economy. Institutions aren't just buying XRP for price appreciation, they are buying the utility of the ledger. This creates a unique liquidity floor that functions differently than Bitcoin. While BTC acts as digital gold, XRP is becoming the digital oil for the machinery of global finance. As these ETFs go live, they will lock up vast amounts of circulating supply, creating a scarcity effect that retail investors will only notice when the price begins its parabolic ascent. The hidden mechanism is finally being activated. Ethereum is currently staging a recovery attempt toward the pivotal $2,046 mark, a level that many analysts consider the do-or-die point for its short-term trend. Despite the recent underperformance compared to Bitcoin, the institutional interest in ETH remains robust. The siphon is moving towards decentralized finance protocols, where Ethereum remains the undisputed king. As institutions look for yield in a world of declining interest rates, the staking rewards of Ethereum become an irresistible magnet. The move toward 2046 is not just a recovery, it is a repositioning. Large-scale investors are quietly gathering ETH, anticipating that the next wave of the siphon will flood the smart contract ecosystem once Bitcoin reaches its plateau. A dangerous illusion is forming in the crypto markets today. Many retail traders believe they can wait for a major crash to enter at lower prices, but they are ignoring the new reality of institutional support. The institutional siphon has created a floor so resilient that the traditional 80% drawdowns of the past may never happen again. This creates a liquidity trap for those sitting in cash.
As the floor rises, the window of opportunity for retail investors to enter at cheap prices is slamming shut. If you are waiting for a 40K Bitcoin, you are betting against the largest financial institutions on the planet. The risk is no longer a market crash. The risk is being left behind entirely.
Beyond the immediate price action of Bitcoin and Ethereum, a massive technological shift is brewing on the horizon. It is called the Alpenglow Upgrade for Solana. While most traders are focused on the next few weeks, institutional visionaries are looking toward the second half of 2026. Alpenglow is not just a minor patch, it is a total overhaul of Solana's consensus mechanism. This upgrade is designed to handle the throughput requirements of global institutional finance, making it the primary candidate for high-frequency trading and massive decentralized applications. The Siphon is already beginning to leak into the Solana ecosystem as smart money bets on the infrastructure that will power the.
Why is Alpenglow being hailed as the killer catalyst for H2 2026? To understand this, we must look at the technical superiority it introduces. By optimizing how nodes reach consensus, Solana will achieve near-instant finality with even lower latency than today. This solves the scalability trilemma in a way that rivals traditional stock exchanges like the Nasdaq. For institutions, this is the holy grail. They require speed, security, and low costs to move trillions of dollars. The Alpenglow upgrade transforms Solana from a high-speed blockchain into a global financial settlement layer. By the time this upgrade is fully implemented, the institutional Siphon will have already claimed the majority of the SOL supply.
In this final phase, we analyze the deeper mechanics at play, revealing how these intricate systems operate behind the scenes to influence behavior and outcomes. This changes everything.
To help you navigate this transition, we have ranked the top 10 cryptocurrencies by market cap for stable long-term growth. At the top sit Bitcoin and Ethereum, the undisputed anchors of the institutional Siphon. Following closely are Solana and XRP, the utility giants of the future. We then look at the emerging roles of assets like Chainlink, which provides the critical data infrastructure, and stablecoins, which provide the necessary liquidity. This hierarchy is not based on hype, but on institutional adoption and network effects. By focusing on these top-tier assets, you are positioning yourself alongside the biggest players in the world. This is the blueprint for surviving and thriving in a market that is being fundamentally reshaped. The window of opportunity to front-run the institutional Siphon is closing. While the crowd is distracted by short-term noise and neutral sentiment, the smartest investors are quietly building their positions within the 68K to 70K support zone. They understand that the Alpenglow upgrade and the rise of XRP ETFs are the precursors to a massive liquidity injection in the coming years. Don't let the volatility shake you out of a generational wealth-building opportunity. The floor has been set, the Siphon is active, and the future of finance is being moved into digital vaults as we speak. Position yourself now, or prepare to be a spectator as the institutional tide rises and leaves the unprepared